We're just going to give people a couple more minutes to log in here. I think I'll start at 9:05. All right, we're going to get started, everybody. All right, we're going to get started, everyone. All right, well, good morning, everybody. Thank you for being here virtually, and thank you for being here in person for those of you who are here. So welcome to our technically winter 2025 meeting. Still winter, right? Even though it's going to be almost 70 today. So one of the perks, I guess, of living in New Mexico. So in any event, I'm going to go ahead and get started. So again, thank you all for being here. As always, I'm going to start with the US. Oh, actually, before I start, I just wanted to let everybody know, and you saw this in your emails, I'm sure, but our guest speakers today are representatives from PNM. We're really excited to have them here with us today. We have Alicia Saavedra, sorry about that. Alicia Saavedra, Grant Taylor, and Antonio Granillo here with us today to talk to us about what PNM is doing, some of their economic development initiatives and important stuff going on in the state. So thank you all for being here. We really appreciate it. Okay, so let's start off with the US review, New Mexico economic outlook, talk a little bit about the metros and take any questions. Again, Rayanne put in the chat, if you have any questions, go ahead and let her know and she'll get that to me and I'll address them either at the end or throughout. So feel free to ask questions. Okay, so a very quick review of the national economy. So the job gains in 2022, solid 377,000 jobs per month, slowed in 2023, 251,000 jobs per month, then slowed further to an average of 166,000 jobs per month in 2024. We've experienced 56 of the last 57 months, or of the last 56 of the last 57 months, there have been positive job addition. So a long period, basically since the end of the initial shock at the beginning of the pandemic, we've seen job gains in virtually every month. I think in the private sector, there's been a couple other months that we've seen flat or negative growth, but essentially we've seen positive growth for more than the last 4 years. The newest data for January 2025 came out this morning. I was busy refreshing my computer busily at 6:30 in the morning until the data came out. 443,000 jobs added. This actually was a little bit below expectations. I don't think it was a ton below expectations, but it did come in below what most analysts thought it was going to come in at. The Federal Reserve cut rates in November and December. Now it's at a range, the federal funds rate at a range 4.25 to 4.5%. The next meeting is the middle of next month. And of course, the Fed will assess if it's time to cut rates again or to keep things where they currently are. Initial and continuing claims for unemployment continue generally to be low. In fact, the U3 rate, the kind of the unemployment rate that we see in the news and generally posted, 4.0% in January. That was the data that came out this morning. The U6 rate, and actually, if you look back to our last meeting, I think we were seeing about 4.1 or so. So that ticked down a little bit. U6 registered 7.5%. Again, if you went back to last meeting, you'd see that that ticked down a little bit as well. Real GDP, 2.3% for the most recent quarter, which is the fourth quarter of 2024. For the year, the average was 2.8%. So the US economy in terms of production grew 2.8%. Kind of an interesting factoid that I just was looking at the data through time. It was the fourth consecutive year where GDP grew at a rate of 2.5% or above for the year. And that hasn't happened since the beginning of the 2000s. So it's been about 20 years where we've seen this consistent rate of growth for a 4-year long period. West Texas Intermediate price for crude was sitting about $71 a barrel this morning. It actually had ticked up last week and the week before to between $75 and $77 a barrel, but that's come down about 8% or so since then. Consumer sentiment, as we know, consumer sentiment at the beginning of the pandemic really ticked down, basically cut in half. Over the last 2.5 years or so, we've regained about 50% of what that sentiment index was at. So up to nearly 75. So, and this is from the University of Michigan. So pretty good general trend. And I'll show you a slide that shows the general trend that we've seen over the last 2.5 years. ISM manufacturing index indicates that manufacturing, kind of the industry overall, has contracted basically more than the last 2 years, with the exception of 1 month over that period. Services index, so the non-manufacturing index, this is what's really carrying the water for the economy. 52 out of the last 55 months, we've seen expansion. So some concerns there I have at the bottom. In some sense, this isn't much different than what we've seen in the past, but I think the focus is a little bit different here. So obviously some geopolitical concerns. We still have challenges in Russia and Ukraine. We still have challenges in Israel and Palestine, even though that looks like that's somewhat clearing up at the moment. The sort of the newer issues, and this is really brought about by the new administration and the interests that they have, is tariffs and the challenges that that may present to the economy and potential trade wars. And we saw last week the sort of the initiation of increase of tariffs against Canada and Mexico, and those were backed off. But if you just watch the market, you saw the market really react to that. It's not necessarily the best indicator of the overall health of the economy. That said, most economists aren't in favor of kind of across-the-board tariffs because it tends to basically raise the cost of goods and services. So tariffs and potential trade wars, and of course immigration as well. The immigration piece is interesting, obviously for a number of different reasons, but one of the things that's interesting for the US, and I think I've mentioned this the last couple of meetings, is that one of the challenges for the US economy has actually been really tight labor supplies. And to the extent that immigration policy is going to kind of crimp labor supplies even more, that's going to make it a challenge for businesses to hire and could potentially actually escalate the rate at which wages go up, which on the one hand isn't a bad thing in terms of wage increases, but on the other hand, could be a bad thing in terms of the end cost to consumers for goods and services. And so to the extent that you expect anything inflationary here, both tariffs and kind of this crackdown in immigration would be expected to both push up prices to the end consumer. So some concerns there. Okay, so inflation over the last couple of years has moderated somewhat. Not as the price growth has not slowed as much as maybe folks would have liked. In the most recent month, which is December, CPI increased compared to the previous December by about 2.9%. So prices overall went up about 2.9%. If you exclude food and energy, so the rest of the economy, excluding food and energy, prices increased 3.2%. So still higher than what we would like to see. The Federal Reserve, in terms of when they try to determine their kind of monetary policy, they really are kind of looking for 2% price growth or maybe 2.5%, sort of a range in there. And we're exceeding that at the moment, even though price growth has come down some over the last, obviously, 2 or 3 years. In general, job openings have ticked down from the peak that we were seeing right around mid-2022. You can see, and this both has the US and New Mexico. The US is on the left axis, it's the blue line. New Mexico is on the right axis. Obviously, these scales are very different, but I'm just trying to show you how these trends generally mirror each other. New Mexico tends to be more volatile. It's just the nature of having a relatively smaller kind of data set. You see kind of these larger spikes up and down. Nevertheless, we see these trends just kind of tend to mirror one another. And the story is that compared to what we were seeing a couple of years ago, the number of openings are generally down sort of across the board. Supply chains, I've shown this slide for some time. Basically, when you see this red line above the kind of dark horizontal line at 0, the supply chains are constrained, they're pinched. Businesses are having difficulty getting their products to market, and that effectively increases the price of getting goods to market and ultimately increases the price of goods to the final consumer. And so we saw from the period basically at the beginning of the pandemic through mid-2023, in general, these supply chains in a very challenging place. More recently, over the last about almost 2 years, we've seen things revert back to normal or actually be a little bit looser than we've seen in the past. So supply chains generally in good shape at the moment. Generically, the market. So I'm showing up here S&P 500 index values and the NASDAQ index values. We are at or near record levels for both of these. Obviously, this varies day to day. This can vary based upon a piece of economic news that comes out day to day. It can vary based upon the the policy put forward or the particular initiatives put forward by the administration or what Congress is doing or what have you on a day-to-day or week-to-week basis. But nevertheless, the point here is that these index values are near all-time highs. So the market, generically speaking here, doing quite well. So as I talked about near the beginning, consumer confidence, we hit a low sometime June or July of 2022 of an index value of 50. Obviously, higher numbers here are better. Before the pandemic, we were sitting over 100. We've seen that obviously come down over from 2020 through 2022. But since then, the general trend, although there here also has been peaks and valleys, the general trend has been up. So consumer confidence higher now than we were seeing, you know, two years ago or so, 2.5 to 3 years ago. Interest rates are high compared to what we've seen over the last 25 years or so. The most recent interest rate, so this is the 30-year fixed interest rates, so mortgage rates, sitting near to 7%. So we're not at a high at the moment. We hit a high sometime kind of the end, I think, of 2020 or beginning of 2024 or so of about 7.8%. We're not at that at the moment. However, we are near the high, really. I mean, we've only seen a couple of other points where we've been at that level over the last 25 or so years. And as I've said over the past, I don't know how many quarters, but you have to go back to the early 2000s to see interest rate levels and sustained interest rates levels at or near where we currently are. So by recent historical standards, where recent is the last 2.5 decades, we are quite high. If you go back further in history, we kind of are sort of where we've been, sort of average rates. But these are obviously higher than a lot of consumers and businesses would like. It makes it more expensive for businesses to borrow, makes it more expensive for consumers to purchase things on credit or to obviously purchase homes. And so that's where we are here. And I think that people would have hoped that with the Federal Reserve bringing down rates over the last, year or so, year and a half, that these rates would have come down more. But here we are. Okay, so real GDP growth, as I mentioned, the fourth quarter 2024 grew 2.3%. If you look at that last column, it's what of these components have added to this 2.3%. The things in bold are kind of the roll-ups for each of the individual categories below. So for consumption, if you sum up durable, non-durables, and services, that is what makes up that 2.82 points. So consumption adding 2.82 points to that 2.3 points of growth. So consumption doing quite well. If you look at the growth rate for consumption in the quarter, 4.2%. So fairly strong rate of consumption growth in the most recent quarter. If we kind of look down the list here, residential fixed investment growing at a reasonable rate after 2 months or 2 quarters of contraction, 5.3%, adding 0.2 of a point to growth. Non-residential fixed investment bringing things down about 1/3 of a point. We look kind of skipping down below changes of private inventories. Net exports basically kind of canceling each other out. Federal and state and local government adding nearly 0.5 point to that top line. The real big kind of negative here is changes in private inventories. So there's been basically a selling off or kind of a reduction of the private inventories, which pulled that top line down by nearly 1 point. And so that's kind of the big reduction there is coming from this sort of this almost, it's not a residual exactly, it's kind of a measured thing, but it's something that if you actually look from period to period does get revisions because more information about business inventories are found kind of or discovered later. And so that may be adjusted either up or down in the next couple of months as more information comes out. But at the moment, 2.3%. So the U.S. employment situation, so I added the most recent data, which came out this morning. And so we are sitting at about 159 million jobs in the U.S. Obviously, this is an all-time high. We're well above where we were before the pandemic at 152.4 million. And as I mentioned, and I don't actually have the number on the slide there, I have it kind of just written below. The UI rate for January was 4%. That's actually ticked down, 1/10 or 2 compared to where we were a couple months back. The growth over the recovery has really come from the private sector. So the black line references the left axis. You see a lot of the growth, especially right out of the pandemic, coming from the private sector. We've seen that taper off quite a bit. In terms of the government sector, which is kind of the purple line referencing the right axis, we've seen at the beginning of the recovery sort of moving sideways, slightly up, but not nearly as fast as what the private sector was doing. But over the past 2.5 years, we've seen the government sector really kind of tick up in terms of its rate of growth. Again, this is an instance where the scales on the left and right axis are very different. And so keep that in mind. I'm just trying to show you kind of the trends and trajectories, since you can kind of compare private with government. But obviously, in terms of raw numbers, the size is much bigger in the private sector. So as a result, in the private sector, compared to pre-pandemic levels, the recovery is that is accounted for is about 6.1 million jobs. In government, about 733,000 jobs. Oops, wrong direction. This slide basically shows you what the total gains are month over month. Obviously, the big losses and the big gains happen right around the time of the pandemic. The thing probably that's most interesting is the red line, which is referenced to the right axis. That's the year-over-year rate of growth, which, you know, as we are at or near sort of full employment, right around 4% unemployment rate, this rate of growth, as we would expect, is slowing. And so according to today's data, the rate of growth in January was 1.3%, actually right below 1.3%. So this rate of year-over-year growth is slowing. And again, that is what you would generally expect as we are at or near technically full employment. Participation rate and the employment to population ratio. So these things have like really not changed over the last basically 2.5 years. Employment to population ratio, about 60%. Participation rate, about 62.5%. You can see the data there on the screen from January, which is right around sort of those average numbers that we've seen. Again, these tend to go up and down a little bit, vacillate from month to month, but they've sat at those kind of in that really right around those numbers for quite some time. So regardless of whether there's huge increases in employment growth or what have you, we still have seen these rates kind of just sit at these levels for quite some time. Private sector wage growth. So this is looking at private sector real wage growth and actually real wages. So real wages, that's the blue line, it's on the right axis. So these wages are adjusted for inflation. The left axis is looking at year-over-year rates of growth. So what you see, and again, I say this every quarter, but just to kind of put a head on it, is that horizontal line that I've added there, the darker one, where the red line is below the black line. We've seen inflation eating into wage growth. So even if we had wage growth or real nominal wages increasing, inflation kind of prices were increasing at a faster rate. So that pushed over the period of about a 2-year-long window from around March or April 2021 to around March or April of 2023. We saw inflation kind of prices growing faster than wages. Since then, however, we've actually seen wages grow faster than inflation. So we've had 20 consecutive months where wages, kind of real wage, well, private sector wages growing faster than inflation. So positive real wage growth. The data that came out this morning, we just have the nominal data. So this isn't included in the slide because what's shown in the slide is adjusted for inflation. So the nominal, non-adjusted for inflation, wage growth for January was 4.1%, again, year over year growth. And so assuming that prices grew less than 4.1%, we will have the 21st month in a row of positive real wage growth. Okay, so some key forecast assumptions. I'm not going to kind of read all of this to you. This is actually in the forecast narrative that we email out, both in the US section and the New Mexico section. Basically, these are just kind of pulled directly from S&P's assumptions. And I do that so that you can see what their thinking is in terms of the trajectory of the US economy, because those assumptions filter through to our New Mexico forecast as well. And so some kind of top line stuff up there. They're assuming the debt ceiling is raised basically without much problem, that the Treasury will continue to do some extraordinary acts to make sure that debts aren't defaulted on, et cetera. Personal tax policy, they extend the tax kind of cuts that the first Trump administration had enacted for a longer period of time. They assume that there will be some exclusion to income tax from tip and overtime pay. Corporate income tax policy is assumed to decrease from the rates 21% to 15% for corporations that produce domestically. And those are kind of the major ones there. Monetary policy, basically hitting a low of 3 to 3.25% by early 2027. And trade policy, I think that's kind of the one that is important there. The average effective tax rate increases from 3% in the first quarter of 2025, so in the quarter that we're currently in, to 16.4% by the first quarter of 2026. This assumes a 10% universal tariff and a 30% tariff on imports specifically from China. And so basically the effect of this is increasing essentially the tax on imports coming in, which of course would be passed on to the consumer. Okay, so some comparisons of federal deficit. So basically the red bars here are looking at what the annual kind of the annual debt is in each year of the forecast, and this is again coming from S&P. Basically, the bars are below the line in this case, meaning larger annual debt, and so or larger annual deficits leading to larger debt. And so you can see where the forecast portion is past that hashed line. So slightly larger annual deficits are expected in this forecast compared to our October forecast, or S&P's October forecast. Some changes in this forecast from October in terms of the trajectory of some important variables. So GDP growth in this particular forecast in the very near term pushed down a little bit compared to in October. Over the long term, essentially unchanged. So again, these are the growth rates. Employment growth pushed down in the near term. This is a little bit misleading. 2025 is actually pushed up just a tad, but 2026 is pushed down by more than 2025 is pushed up. And so kind of the near term for me, I kind of have that marked as being pushed down a little bit, even though 2025 is slightly stronger. And that actually filters through to the New Mexico forecast too. Over the long term, pretty similar over the long term compared to October forecast. Income growth actually pushed up in the near term compared to our last forecast, but over the longer term pushed down a little bit. Some of the gains in the near term are kind of paid for with slower rates of growth over the longer term. The price of oil pushed down both in the near term and the long term. This has to do with the administration's policy to increase domestic production. Consumer price index actually priced higher, especially in the near term. As I mentioned, this is a result of both the immigration policy and also the tariff policy put forward by the administration. Over the longer term, essentially unchanged. And housing starts as a result of generally higher prices, persistently slightly higher interest rates expected in this particular forecast, pushed down throughout, which isn't necessarily ideal because we generally have a housing shortage. We have a housing shortage in New Mexico specifically, and generally in the US as well. So some comparisons here, and this is looking at the quarterly data, and this is GDP. The bars are for 2025. The lines are for January 2025. The line is for October 2024. You see a little bit of distance there below the line. The bars are below the line in the very near term. So GDP, as I mentioned, kind of pushed down a little bit, and then kind of over the longer term, very similar to a previous forecast. In terms of employment growth, as I mentioned as well, you probably can't even really see it, but 2025 pushed up just ever so slightly. The real big difference here is here kind of in 2026, 2027, and 2028, really kind of the end of 2025 through the very beginning of 2028, where employment growth is actually pushed down enough to where in 2026 and 2027, the average rate of growth for the year is actually in S&P's forecast is actually negative. Actually, that's an important point. So things are pushed down a little bit just overall, especially for the major economic variables other than income. And that said, there's actually no expectation in this particular forecast for a recession. This changes quarter to quarter. They adjust their thinking on things, what have you. But the thing that's sort of different in this forecast is what we've seen in the past, generally, not every forecast, but generally, is that employment growth is pushed down, but like pushed down and still slightly positive on an annual basis. In this particular forecast, it's actually pushed down and slightly negative. So, on the margin, probably not that much different from what we've seen in the past. But I think that the fact that in 2026 and 2027, the expectations of things being negative rates of employment growth in this particular forecast is at least notable. We'll see what happens in their next forecast. They may push things up again, but this is what we have in this particular forecast. And because the New Mexico forecast is tied to the US forecast, that obviously filters through to our New Mexico forecast too. Of course, as I'll show you when we get there, that isn't to say that we're expecting reductions in employment numbers in New Mexico, but those rates of growth are pushed down a little bit relative to our last forecast. Okay, so by industry, we have S&P's industrial kind of employment change from year to year. Positive numbers means in that year, these positive numbers in black are added on a year compared to the year prior. The numbers in red mean that those number of jobs are expected to be deducted or reduced. And so the red numbers represent loss of jobs. The black numbers represent gains. And so we've got construction, manufacturing, trade, transportation, utilities, et cetera. You can see at the very bottom the annual rates of growth, as I mentioned. So 2025, 0.9 of a point is the expectation. So the year that we're currently in, and these are calendar years, 0.9 of a point, slightly below 1%. 2026 and 2027, reductions of 0.1% in each year. Again, these are like on the margin. So basically flat, but they have kind of hedged to the slightly negative side. 2028, very slow rate of growth, 0.2 of a point. And then we start getting into 0.5 point, 2029 and 2030. So very slow rates of growth. Oh, and by the way, these slides have been updated to show you 2030 this time rather than just through 2029. So we're getting that extra year in this particular forecast. In terms of the specific industries that are expected to do relatively well or to kind of pull things down, really manufacturing, trade, transportation, and utilities, the ones really pulling things back. We see a couple of years it kind of near the end where you have leisure and hospitality and other private kind of pulling things down. The industry is doing quite well over time, generally speaking. Professional and business services, although for whatever reason, 2027 down 437,000 jobs. Can't really tell you why that is. I think just other model kind of spit things out. I don't think there's really any super rationale or justification there, but I think that they're looking over the longer term, sort of smoothing things out in terms of what they are anticipating. Consistent rates of growth in healthcare and social assistance. And what you'll see in the New Mexico forecast is that's what's really kind of pulling things along throughout, especially, well, even in the early kind of near term, but over the longer term as well, is that's the industry that is really pulling things along. Probably expected. It's a very large industry. It's especially large in New Mexico, and we are even so underserved and in health and social assistance. And so there is an undersupply of workers in this particular industry, and the demand is very, very high. And so the expectation is over the course of the forecast, specifically in New Mexico, that's going to be the industry that you're going to see is the one that, at least in this forecast, is really kind of moving the economy forward in terms of just raw numbers of employment. That trade, transportation, and utilities can be summed up by retail trade, really. So it's less about less about transportation and utilities, although utilities is a small industry in terms of raw numbers. I think that the general trend expected for that is sort of negative, but really in terms of raw numbers, it's retail trade. So retail trade really bounced back after the pandemic. It was one of surprisingly the industries that did especially well after the pandemic. But the forecast, and this has been the case for quite some time, the forecast over the longer period is that the economy is going to pay for it in terms of just in terms of the larger job losses there. Wholesale trade is in there too, of course, but it's quite a bit smaller than retail trade. But it really is a retail trade. You'll see this in the New Mexico forecast also, where retail trade over the period from like 2025 through 2030 is one of the industries really pulling things back. And so it's retail trade. Unemployment comparison. This isn't substantially different from what we've seen in the past. The black hashed line is the most recent forecast, actually pushed up about 1/10 or 2/10 of a point compared to last forecast over the window, but not substantially different. Personal income forecast comparison. It doesn't look like it's substantially different in the near term, but actually it is pushed up a bit. Things get swamped by those really huge increases and reductions coming out of the pandemic. So it's hard to see when there's like a 3 or 4/10 of a point difference. But I assure you that in the very near term, these rates of growth are actually pushed up pretty considerably. Disposable income growth, you actually can see it a little bit more, and this is year over year rather than quarter over previous quarter here. But especially in kind of 2025, you see disposable income get pushed up a bit. You see kind of a little bit further out disposable income getting pushed up some too. And this is actually a result of nominal income getting pushed up sort of more than anything else, and it filtering through when adjusting and turning it into disposable income. Okay, so this is actually one of the areas where where things are most noticeably different, kind of easier to see the difference. The other one you'll see is housing starts. But basically here we have the forecast this time, January 2025, the bars, and last time in October, the line. And you can see a pretty dramatic reduction in the price. And this really has to do with increasing expected supplies more than anything else. And so price pushed down in this forecast compared to last forecast. You actually can see it, although not quite as well in the natural gas forecast, but you would expect sort of similar behavior here. And so the bars generally below the line, meaning price is generally below what we expected the last time. Consumer price index, this isn't looking at this time versus last time. What this is looking at is CPIU and core. So core stripping out food and energy. And you can kind of see what these prices look like. And so in the very near term, at least through basically kind of 2027, 2028, price growth above 2%. So staying elevated until around 2028 or so. So as I mentioned like 15 seconds ago, housing starts is one of the areas that where there's been a pretty considerable change in thinking. And so basically here we have housing starts well below in this forecast where they were expected in the last forecast. And this really has to do, and maybe unexpected, although the fact that interest rates are continuing to stay high, and overall prices themselves continuing to stay high. And this actually, the lack of housing construction will actually exacerbate that. In this forecast, we have housing starts just quite a bit lower, noticeably lower. And then I have up here just kind of your interest rates, 30-year bonds, conventional mortgages. That's the conventional mortgages is that top line, federal funds rate, and the three-month T-bills just as another interest rate that you can look at. And so you see a very slow decrease in the rate of the conventional mortgages, and you can see the stepping down of the rates of the federal funds rate. So the green line there, you can see it kind of stepping down over time and hitting right around 3.25% by around 2027. Okay, so that said, some context in terms of what goes into the New Mexico forecast, some of the historical data for the US, et cetera. We'll move on to the New Mexico portion. So New Mexico current economic situation, the data continues to be pretty solid for New Mexico. The job addition numbers continue to be good. The unemployment rate numbers, although elevated relative to the US, still pretty good. But on the horizon, what we are seeing is that things are slowing. And this is the case in New Mexico. It's the case in the US. Job addition is slowing. In general, kind of the trend and trajectory is slowing. The question is by how much and how quickly. And so obviously, S&P expects for 2025 that the rate of growth is going to slow from this year right around 1.5 to 1.6% to 0.9% to about 1% great growth in employment, which actually isn't the worst in the world, reasonably okay. But by 2026 and 2027, really flatlining, in 2028 even really flatlining. And so that's kind of what's baked into this New Mexico forecast. So at its lowest, New Mexico down about 90,000 jobs. As we all know, we're well above pre-pandemic levels at this point. The most recent data that we have from QCEW is the second quarter of 2024, so obviously a little bit dated. Through that second quarter, employment somewhere in the range of 2.5% to 3% above pre-pandemic levels. We also have the benefit of CES data, the monthly data that comes out, monthly survey-based data, which is through December 2024. And that data suggests that we're about 3 to 3.5% above employment levels, so number of jobs compared to the pre-pandemic levels. The unemployment rate is staying, fairly moderate, pretty good shape. West Texas Intermediate, haven't checked it for the last couple hours, but this morning when I got up, $71 a barrel. Drilling and production, again, and I haven't changed this for forever, still robust and continues to break records after plateauing for a little bit. So comparing New Mexico to other states, at least in terms of gross state product, New Mexico is kind of the magenta line there. You can see sort of, an index back to each state's respective fourth quarter in 2019. This particular quarter was picked because that's when New Mexico's pre-pandemic gross state product levels was peaked. And so I put every state back to their respective levels, fourth quarter 2019. So you see New Mexico kind of in the middle of the pack there, right at the beginning of the pandemic, out-competing actually a lot of states, which is what you actually tend to see New Mexico do right at the beginning of a national, or in this case, global economic downturn. We saw New Mexico actually kind of fall behind at the beginning of the pandemic recovery, but actually over the last couple of years, New Mexico has kind of fought back. And at the moment, gross state product, and this is real gross state product, so adjusted for inflation, up 11% compared to pre-pandemic levels. And only 21 states have had greater recoveries in terms of relative to the fourth quarter of 2019 for each of those states. And so New Mexico kind of in the middle of the pack, actually a little bit above the middle of the pack there. Let me actually go to this one instead. So the employment slide that's very similar to the gross state product slide. Very similar story here. New Mexico not hit nearly as bad as many of the other states at the beginning of the pandemic, but the recovery had been slow for some time. And then we actually started catching up. New Mexico is really right in the middle of the pack in terms of the recovery. And it says as of September, it should be December 2024. We are about 3.5% above where we were prior to the pandemic. The problem is, and you'll see a few themes like this throughout, is that our surrounding states have tended to do better than New Mexico. So Arizona, 10% above pre-pandemic levels, Colorado, 7% above, even Oklahoma, 6% above, Nevada, 10% above. I've got California up there just for reference because it's ginormous and obviously a very large economy. So about 3% above where it was prior to the pandemic. Let me actually go back to this slide very, very quickly. So just back a slide. Year-over-year change in labor force by place. I'm not going to belabor this exactly, but just to say the labor force numbers suggest that New Mexico is about, the labor force size is about 2% in terms of number of people 2.1% above pre-pandemic levels. You can see where those that labor force has grown. Obviously, Albuquerque MSA is quite big, so you would expect a lot of the gain to be from there. But many of the, well, really all of the other places have sort of added labor force over time. And really, for the most part, since early 2020, basically since the recovery from the pandemic in earnest, so March 2021, we've seen more or less gains in labor force numbers pretty consistently over that period and in almost every place. Okay, so sorry, do that and then skip ahead to some oil stuff. So increase in New Mexico field oil production presence. So in October 2024, rigs dipped to below 100, but that actually ticked up to over 100 by the end of January. I haven't checked the most recent week's data. It might be the case that things have ticked down. They may have ticked up, not really sure. But by the end of January, when I was kind of putting this together, things had sort of ticked back up to 100. Really, the rig counts have stayed in New Mexico above 100 pretty consistently for some time. About 17.5% of all U.S. drilling rigs are operating in New Mexico as of the end of January. And about 15.5% of all U.S. field oil production occurs in New Mexico. That's up from about 4.5% in 2016. And I actually updated the next bullet here because we have the benefit of another full year of data, and I just hadn't updated it. So to put all the kind of increase in oil production in perspective, 2023 field oil production in the U.S. totaled 12.935 million barrels per day, which is up from 8.9 million barrels per day in 2016. That's a 46% increase over that period. In New Mexico, and I won't read the actual numbers there, but in New Mexico, oil production has increased by 363% since 2016, which is, to me, crazy. Like, it's insane. It's such a huge increase. The kind of the understanding and the of the formation in New Mexico and the Permian Basin has made it such that it continues to be an especially productive place to produce. And so that's where that's coming from. And as I mentioned, basically every quarter, you know, the oil produced in New Mexico goes a long way to kind of bolstering state budgets and effectively impacts what the state is able to do and the initiatives that the state is able to engage in. So that you know is a huge inflow of money to the state. And incidentally, at the bottom there, in the most recent month of data that we had, which I think it was December, from EIA, and I kind of pulled the data from EIA, federal energy folks. New Mexico accounts for around 8% of U.S. gas production by volume. So there's that. I won't belabor this one either, but basically there had been a move towards more efficient oil production. The number of workers per drilling rig, really kind of at the beginning of 2016, where this huge increase in production started to happen, quickly fell. And we've been sitting at, and this is on the right axis, the blue line, we've been sitting right around 210 or 220 or so jobs in the mining industry. And again, this is mining broadly construed, not just oil. I can't really break it out on the monthly data. Just mining in general, which most of it is oil and gas production, but has been sitting right around 200 to 220 jobs per drilling rig. You kind of just divide those together, divide them, and then you get kind of that sort of ratio. Production per job referenced, oil production per job referenced to the left axis, barrels per day. We'd seen that really kind of increase. So basically what this is saying is, even when we've seen increases in the number of jobs in the mining industry, we're seeing oil production increase more. And so that increasing slope of that red line is basically what that is saying. So we're becoming more productive with effectively fewer workers, or the same number of workers. Okay, so switching gears here to housing sales and prices. So this is looking at all of 2024 versus all of 2023. On the left, we're looking at sales, so sales of homes. On the right, median sales price and broken down by place. So broken down in this case by all of the MSAs. I also break out Lee and Eddy County, kind of separate put those counties together. And then the rest of New Mexico is New Mexico minus all those other places that are shown on the screen. Statewide, sales were down in 2024 by about 12% compared to 2023. You can actually see sort of where these reductions, the largest reductions happened, Las Cruces and the rest of New Mexico. Sales were also down in Santa Fe, but not by quite as much. But they were up in Albuquerque. So the biggest bar there on the left, the Albuquerque MSA, sales were up. If you look at the Greater Albuquerque Realtors Association, that's that bottom bullet there, sales up for the Greater Albuquerque region, about 1% for the year. If we look to the right, median sales price, you see sales prices up basically everywhere, about 7% statewide. And so you can see what those median sales prices are that increased from $323,000 in 2023 to $345,000 in 2024. And you can see what that looks like in Albuquerque. Albuquerque prices up in 2024, 4% to $360,000 per unit. So here we are. So again, sales in general, mostly down throughout the state, but price continues to go up. Okay, taxable gross receipts. So these are receipts that are taxable, and you can see by industry. And this is looking at the third quarter of 2024, and I'm on the left subtracting away the third quarter of 2023, so you can see gains or losses. On the right, you can see the rate of growth over that period. Again, this is just looking at that one quarter, year over year. And you can see the industries. Other here, this is kind of the amorphous NAICS Sector 81. Go ahead, Rand. I'm not entirely sure. So the question is, what about new housing in New Mexico, and whether there has been kind of increases or the rate at which new housing has changed. That actually is, so there's a couple layers to this. So there are one thing that we actually measure is housing permits. We actually get data from each of the housing permitting jurisdictions. You would assume that housing permits pulled correlate to housing starts, but that isn't always the case. And so kind of definitionally, we don't know exactly the number of starts that have occurred, but we, as I mentioned, do have data from that we pull from the permitting granting jurisdictions on permits. Actually, if you look at the forecast spreadsheet that we send out, we actually have a line that has permits for total permits, multifamily permits, and single family permits, and we have them. Those three that kind of breakout for New Mexico and for the city of Albuquerque, and then we have just total permits for the cities of Las Cruces, Santa Fe, Farmington. I think that's all that we have in the forecast spreadsheet. I think that permits in general are up a little bit compared to what we saw at least a year ago. And so that's a good sign. But again, pulling a permit's a little bit different than actually starting construction. There used to be a company that we subscribed to it was probably a decade ago, that actually what they did is their employees literally drove around different areas of the state and counted started construction. And so, and again, I don't know whether this company exists anymore. We definitely don't subscribe to their service anymore because it's extremely expensive. It's called Metro Study. And that's what they did. They literally would count started units. So our assumption is basically that starts and permits are generally correlated, but you would imagine there's going to be a lag, et cetera, et cetera. And so while they are up from a year ago, they're still pretty low by historical standards. Yeah, go ahead. Oh, okay. So it's now called Zonda. Okay. All right. Yeah. So, yeah, we haven't subscribed to them probably for a decade or so. So I don't know if anybody else has any insight into what the actual numbers are. So I can't I can't totally answer that, because so the question is the correlation between permits and starts pretty constant over time? Our assumption was that our assumption has always been that permits and starts are generally fairly well correlated. As I mentioned, one thing that we know just by definition is that there's going to be a lag between permits and starts, because you pull a permit and you can't start construction the day you get the permit. It takes some time. But we also know that some of those permits that are pulled are not actually going to uh, uh, end up becoming a started unit. And so I'm guessing that there is variation from time to time in terms of what gets started and what doesn't get started. I imagine that there's a bunch of different covariates that go into this in terms of what is the inflation at the time that you're actually starting, what do interest rates look like, or even if units start getting built, is there a difference in terms of the length of time of construction from one period to another? So again, our assumption is generally they're fairly well correlated, but we don't know exactly how well correlated, or like what percentage if from time to time turns into a unit and how long it takes, et cetera. Any other questions on that, or we? Okay, cool. Okay, taxable gross receipts. As I mentioned, that third quarter, other at the top, this is kind of other NAIC Sector 81, so a weird kind of hodgepodge of kind of service type industry stuff. So this isn't a residual exactly. This is an industry, other services. Construction doing quite well in the quarter, professional and technical services doing quite well. The thing that you'll notice down near the bottom is mining actually a net negative in terms of overall taxable gross receipts. I'll show you something interesting on the next slide in a minute about this. Also pulling things down, administrative, and I'll there explain something kind of interesting in the next slide too. Overall, taxable gross receipts up 415 million, or about 1.75% 1.7% year over year. So taxable gross receipts up, but you see those reductions at the bottom. In terms of the places, so really pulling things along, Eddy County, Bernalillo County. Other here is literally a residual. So whereas in the last one, it's not, it's an industry. Other is other counties not represented on the slide. So other actually, this implies that most of the other counties actually pretty substantially added to the bottom line, but just didn't make the cut for actually showing up on the slide. So most other counties actually kind of adding to that taxable gross receipts addition for the year. What we see at the bottom there is Los Alamos being the major drag, and also Lee County. So what's interesting about this, in my opinion, and I went and looked at the actual data, the county level kind of and by sector data, is that Eddy County, what's really pulling things along for them, and if we went back to the last slide, remember, mining was actually a net negative. Eddy County, where a lot of their positive is coming from, is actually mining. So whereas the state was negative in terms of mining, Eddy County, mining in Eddy was positive. Conversely, Lee County was exactly the opposite. So Lee County, their mining taxable gross receipts in the third quarter 2024 versus the third quarter 2023 actually a net negative and pulled things down. So if you kind of they end up more or less canceling each other out, slightly more on the negative side than the positive side. Is, in absolute terms, is larger on the negative side, so slightly negative. The very bottom there, we have Los Alamos, kind of the big negative. And so if you remember from the last slide, it was administrative, the administrative industry, kind of, I just have admin up there. And actually admin in this case includes things like waste management and the like. And so that's really what got pulled down in Los Alamos, is admin and waste management. And so those were the two things pulling down taxable gross receipts in the state more than really anything else. Okay, state recurring revenues. These data are just for the first 2 months of fiscal 25. So July 24, August 25. And this is comparing to, and this actually should be FY25 versus FY24 at the very top of the slide. So, and in any event, looking at July 24 and August 24 and subtracting away July 23 and August 23. And you can see where the revenues to the state are, the recurring revenue is kind of really being propped up. It's actually kind of everywhere, but there are a few things that are really kind of pushing things up relative to a year prior. So investment income is doing quite well, adding about 112 million compared to the same 2 months a year prior to the state's bottom line. Also, obviously, mineral production, more than that, rents and royalties, and again, selective sales tax kind of pushing things up. So for the 2 months in the fiscal year that are reported, recurring revenue up about $275 million compared to the same 2 months the year before. Okay, so moving on to the outlook portion. So New Mexico Economic Outlook 2025 through 2030. As I mentioned, we use, well, as we know, we use the QCW to forecast for the state. QCW data is only through the second quarter at the moment of 2024. And so the rest of 2024 is technically a projection. We use the CES data and obviously a couple other data sources to try to, align that trajectory for those kind of estimated second half of 2024. But really kind of the forecast more or less starts for 2020 in 2025. So that's why I have on the top of the slide, 2025 through 2030. As I've mentioned a couple times, employment growth remains solid in 2024, but we're expecting it to slow to about 1% or so in 2025. That's more or less right on line with what the U.S. projection is. I think our projection for New Mexico is slightly faster than the U.S., like a half a point or so, if that. Actually, excuse me, a tenth of a point, if that. But slightly faster in New Mexico than the U.S. The expected slowdown in the U.S. beginning in 2026 and kind of persisting really through 2028, where things are either slightly negative or more or less sideways, affects New Mexico's forecast, and things kind of start to pick up a little bit in 2029 and 2030. As I mentioned, in the US, no recession in the baseline scenario, at least according to contraction of GDP or anything like that. For New Mexico, we're not even anticipating an entire year of negative employment growth in our forecast. The pessimistic scenario, shallow job losses and this is New Mexico, in 2026 and 2027, and generally underperforms the baseline, at least in terms of levels, through 2030. We have the pessimistic 2 scenario, which nearly flatlines in 2025, quite a bit slower in the year that we are currently in compared to the other scenarios, modest job losses in 2026 through 2028, and then kind of starts to bounce back in 2029. In the second quarter of 2020, New Mexico lost about 10.5% in terms of these jobs numbers. Most recent QCW data suggests continued pretty good job growth. CES data through 2020, the end of 2024 suggests the state is more than 3% above pre-pandemic levels. The major offenders pulling things down, you'll see this in a slide in a minute, mining, agriculture, and retail trade. And then a few other bullets there in terms of jobs numbers. By 2030, we're expecting New Mexico to be about 56,000 jobs above 2019 levels. That's about 6.7%. So we've extended this forecast out to 2030, as I mentioned. Our last forecast only went out to 2029. In our last forecast, I think we had anticipated by 2029, the state to be around 53,000 jobs in that year above pre-pandemic levels. And we're sort of right on the money in this forecast because of generally pushed up 2025 numbers, even though the rest of the forecast is a little bit weaker in terms of the trajectory for the state. Income patterns, growth in 2024 estimated in New Mexico, 5.1%. We have 3 of the 4 quarters in the books. So we have most of the year we sort of know. Although, for those of you who watch the BEA data, you know that these data do get revised. Income growth robust over the period 2025 through 2027, averaging about 5.2% per year. Then the rest of the period through 2030 should slow to about 4.7% per year. Okay, so for historical purposes, this is looking at subtracting away the 2019 employment levels from the 2022 employment levels. These are the QCW data. You can see the industries that added jobs basically from 2019 through 2022. Obviously, this includes the period during the pandemic. And so this is kind of which industries bounced back by 2022. We see at the top, transportation, professional and technical services. And as I said before, kind of at the beginning, retail trade overperformed basically everybody's expectations. Over the longer period, if you look at retail trade, we've seen this kind of reduction in jobs numbers in retail trade. And so it's surprising that coming out of the pandemic, things bounced back so much and so quickly. At the very bottom, we see government, really it's local government dragging things down, but in aggregate as a result, government being the major drag. We see mining, even though over this period we're producing record volumes of oil and frankly, and gas, we see mining because the mining industry is doing more with fewer workers. And so even though employment is low relative to 2019 levels, the industry is doing in terms of production very well. Accommodation and food services, one of the industries really dragging things down over this period. COVID-related restrictions and consumers generally kind of changing their preferences, pulling things down. Most other industries, being reduced by fewer over that window by less than 1,000 jobs. Okay, so this is looking at 2020 quarter one through 2023 quarter one. And this is basically just to show you the fact that both government and mining, so 2020 quarter one, basically the last quarter that we have fairly reliable sort of pre-pandemic data. This isn't perfect because obviously the pandemic happened and things started shutting down sometime in kind of March. And so some of this quarter may have some pandemic in it, but this is kind of the last one before we see the real big drop off the second quarter of 2020. So in any event, government still pulling things down, mining still pulling things down. Again, with government, local government being the major offender here, and mining, same story there, producing record volumes, but the industry is producing more with fewer workers. Okay, so fast forward, I showed this slide the last time. We see at the top, professional technical services, retail trade doing well. This is looking at 2024 quarter one and subtracting away 2020 quarter one levels. So again, last quarter really before the pandemic kicked off in terms of seeing these really big losses. So all these industries above pre-pandemic levels at the top, the bottom. Now we're seeing mining and agriculture being the major offenders here. Local government has added back most of the jobs that it had lost prior to the pandemic. So local government growing at a pretty rapid clip, even from over the period 2023 quarter one through 2024 quarter one. So mining doing really well recently, or excuse me, not mining, local government doing very well recently. Okay, so I can't do these kind of comparisons, pre-pandemic, post-pandemic comparisons with this particular quarter. I'm just trying to show you on this slide the most recent quarter data that we have. And this is looking at the fourth quarter for QCW, fourth quarter of 2024, quarter two, looking at second quarter of 2024 versus the second quarter of 2023. And what kind of jumps out at me when I look at the slide is that most of the industries kind of look like it could be any quarter throughout time. Some jobs are lost, some jobs are gained, and depending on the industry, healthcare adding a good number of jobs. Maybe state government is a little bit hefty in terms of the number of jobs added. Professional technical services doing pretty well. At the bottom, we have some industries losing some jobs. Agriculture, mining, and retail, kind of the major ones there, losing the most jobs. In the quarter, the state grew 1.3% in terms of number of jobs. That's nearly 11,000 jobs added. The kind of weird one at the top is local government adding more than 5,000 jobs. So that's the one that really looks out of sorts. Maybe not surprising given how many jobs were lost in the first kind of year and a half to 2 years of the pandemic and pandemic recovery, but that's the one that looks really out of place. As a result, largely of local government and state government doing quite well, government added 7,500 jobs of that 10,800 plus jobs in the quarter year over year. Private sector only grew a half a percent, about 3,300 jobs added. Looking at the CES data, this is through December 2024, just comparing it to January 2020, sort of the high watermark. We can see which industries are above or below. So again, survey-based data. So these data will be revised and benchmarked at some point back to the QCW in the future. But we see unexpectedly mining, information, kind of a weird industry, wholesale trade, and this other kind of other industry, other services, still in the negative there. The other industries actually adding jobs over the period, manufacturing, leisure and hospitality, et cetera. Construction doing fairly well relative to pre-pandemic levels. Retail trade, healthcare, and professional business services being the kind of major gainers there. Okay, so projections by industry. So this is actually looking at 2025 versus 2024. How many jobs by industry are expected to be added? The largest number of jobs are expected in healthcare by more than double the next one. Accommodations, about 3,300 jobs in healthcare, about 1,400 jobs in accommodations, about 1,250 jobs in construction and professional technical services. Things pulling things down here are info and retail. Those are the major drags. Healthcare is very high in terms of the number of jobs. And so I looked at the slide and it actually kind of concerned me a bit. What I will say is this: healthcare is a very large industry in terms of the number of jobs in the industry. And also, at least in terms of our forecast in 2025, our forecast for this industry is about half a point below, in terms of rates of growth, below what the US forecast is. So if we were growing at the rate that the US is projected to grow, this would be considerably larger. So this actually was tamped down relative to what the US is looking like. And so in some sense, if we grow at the rate the US is projected to grow, this could be an underestimate. I wouldn't bet my money on it, but that kind of made me feel a little bit better that this isn't so out of sorts relative to what the US projection is. In terms of retail trade, we are expecting about a loss of 800 or so jobs in 2025. And that's kind of the opposite, where the reduction in terms of rates of growth are expected to be larger in the US than in New Mexico, although negative in both places. And so that's kind of where we are, what we're projecting by industry in 2025. If we use 2025 as sort of the base year, so our projection for 2025 as the base year, and we project forward through 2030, the industries that we're expecting to add the greatest numbers of jobs: healthcare, construction, professional technical services. You can kind of read down the list there. Obviously, healthcare, again, the largest kind of net additions happening there, because it's just such a large industry, and we have such an undersupply of labor in this particular industry that needs to be filled. At the very bottom, manufacturing and retail trade, kind of losing the largest number of jobs. Retail trade, again, sort of payback from all that huge uptick at the beginning of the recovery and the first couple of years of the pandemic recovery. But the expectation nationally is for kind of this downward trend, which, if you remember from that chart that I showed for the US, the trade, transportation, and utilities, the question that somebody asked, that's where this is happening. It's really retail trade. Manufacturing, also another industry that is expected to contract over time, especially as the industry goes more towards automation and the like. Forecast comparison. So this is a little bit hard to see here because we have huge reductions at the beginning of the pandemic and then huge increases at the beginning of the recovery. But the growth rates pushed up a little bit in 2025 relative to last forecast, but pushed down about 1/10 or 2/10 of a point, especially in the medium term. And then you see at the very end here, the black line doesn't go all the way out to 2030 because we weren't forecasting to 2030 in October. Comparing the New Mexico forecast to the US forecast, we are more or less on par with the US in 2025, up. It's actually less than, I think, 1/10 of a point difference between the two, but a slightly faster New Mexico in 2025, ever so slightly faster. 2026, 2027, New Mexico up about 0.2% compared to the US. As I've mentioned a couple times, the forecast in this particular forecast by S&P calls for contraction in 2026 and 2027. 2028, we're up about 1/10 of a point compared to the US. And so we're just running a little bit faster than the US in this forecast, a little bit faster than the US comparatively. Okay, so if we compare our 2030 forecast in New Mexico to our 2019 levels by industry, the industries that we're expecting to do particularly well, and so this is, 11 years in the future relative to the 2019 data. And so kind of looking at it from that perspective, healthcare up about 17,000 jobs over the period, which actually doesn't strike me as a ton. Over that length of a period of time, given a continuing aging population over the period, given an undersupply of labor historically in this particular industry relative to the population's needs, et cetera, a gain of 17,000 jobs doesn't seem to me to be super out of line. Professional and technical services up about 13,000 jobs. One thing that I'll note is that a lot of these gains actually were front-loaded. And so if you look over the period from 2019 through kind of 2024, 2025, a lot of the gains in industries like professional and technical services or transportation for that matter were in that kind of early period actually that we've already realized. And so the rates of growth from 2025 through 2030 for a lot of these is actually pretty modest. And as given by the overall rates of employment growth that we were just looking at, which are 0.2 of a point or 0.3 of a point overall. So pretty slow rates of growth expected from 2025 and out. And then we look at the bottom, kind of this weird information industry. Information is super hard to predict, but based upon just national trends and trajectories, expected contraction, manufacturing expecting to lose jobs or lower in 2030 versus 2019. Even though we're expecting that we're going to lose jobs over the period from 2019 through 2030, in this particular forecast, retail trade actually ends up above. Again, that's not to say that from here through 2030, we're expecting to see positive gain. We're supposed to see gains. Much of those gains, again, were front-loaded at the beginning of the pandemic recovery. So there we are. Okay, so comparing to other states. So obviously, we produce a forecast of the state economy. Other BBER-like organizations and other folks produce forecasts of their respective states. And then Arizona State University's Western Blue Chip Economic Forecast basically averages those forecasts. And that's what you're seeing up there on this slide. In terms of the question is basically what goes into the projections. There are multiple factors that go into the projections. The largest one really is what is the national expectation for the particular industry. So we subscribe to a national forecasting service that provides us with forecasts of 2,000 or so variables. And some of those variables are employment-related variables that gives us trends and trajectories for expectations for those particular industries. So that's kind of where it starts. But in addition to that, understanding and having data or expectations about what the labor market is going to look like, where those supply challenges or demand demand difficulties really might be. And so it's understanding kind of that to moderate or to make to generate a forecast that more clearly aligns with what our expected sort of supply of labor is or what our demands might be in the future. So it starts kind of with the national forecast and gets adjusted from there. And in addition to that, to specific things that we know about the economy that our forecast obviously isn't going to pick up. So if we know that there's a particular industry that is adding jobs or contracting jobs. So for example, and I don't know that there's anything specific in this particular forecast, but some years ago, there was a kind of a train and intermodal project down at the southern part of the state. We had an idea about how many jobs were going to be added as a result of construction and operation at this particular facility. And so we included them sort of as an add factor to our forecast. And so those factors, those things are what we consider and take into account when we're generating our forecasts. Okay, so comparing the New Mexico forecast, New Mexico is BBER's forecast, so our forecast. The other states are these sort of composites coming from these individual states. What you see up here is the forecasts for each of the places in 2025 and in 2026. The left side is employment, the right side is income. US is S&P's forecast. Probably unsurprising based upon what I just said, our forecast and expectations or projections more closely align with what S&P is saying. So in 2025, basically 1% in New Mexico and more or less 1% in the US. New Mexico, our forecast for 2026, 0.2 of a point. S&P actually -0.1. You see the much more robust rates of expected growth in these various states in 2026 compared to New Mexico or compared to the US projection. Arizona 2.1, Colorado 1%, Nevada 1.2, Texas 1.7. Just based upon recent history, I would expect New Mexico to underperform those other states. Nevertheless, they seem to be fairly optimistic relative to what the general expectation is in 2026. And this isn't just from S&P, mind you. This is from other, in terms of what the expectation is in kind of the near and medium term for the forecast in terms of like kind of pushing things down in 2026. In income, we can see what the income forecasts look like. These are pretty similar across the board and again, we follow S&P more closely, of course, than the other states, but generally similar there. Okay, so I was kind of curious about sort of switching gears here. Just kind of trying to look at some data that might just be sort of interesting. And so one thing that I started looking at, and obviously we project this to average weekly wages. It comes in our forecast spreadsheet. But I kind of was curious about how New Mexico stacked up in terms of average weekly wage. And so I know that this slide is probably a little bit difficult to read because there's a lot of stuff on the slide. In this particular slide, New Mexico is the black bar right over at the left. At the very bottom, we have each of the states, and this is for the month of December 2024. New Mexico's overall average weekly wage, according to Bureau of Labor Statistics, $974. New Mexico's average weekly wage is the lowest of any state or place in the country. You're gonna see all the way over to the right, District of Columbia, almost $2,000, their average weekly wage. I have in these blue bars here some sort of states of note. So Nevada, higher than New Mexico, still pretty low, but higher than New Mexico. Utah, lower than the average. The average is actually almost $1,200 a week, but pretty close to what the average is. Arizona, above average. Colorado, well above average. California, as would be expected, an expensive place generally, above average. So I was like, well, it's, New Mexico, but we kind of know what we look like in terms of our average weekly wage is quite low, but that only tells sort of part of the story. What about cost of living? And so I looked at Missouri Economic Research, forgot what the rest of the acronym stands for there, but they have a measure of cost of living. They have a cost of living index that they've published. And what is showing on the slide is on the left. So as you might imagine, West Virginia, lowest cost of living in terms of their index value. You go all the way to the right, District of Columbia, California, Massachusetts, and Hawaii, the highest cost of living. So lower cost of living states on the left, higher cost of living states on the right. You can see, again, states of sort of interest, Texas, just because it's right next to us, actually lower cost of living on average than New Mexico, Colorado. I should have actually put the link here for you to see this data. Colorado, right around average in terms of the index value. Utah, above average, pretty considerably above average. Arizona, more expensive than average, in California, more expensive than average. And so I was kind of thinking to myself, and go ahead. These are just a cost of living index. So this is taking into account a bunch of different costs of living, like household, the cost for a household, costs for grocery to rent or whatever, costs for groceries, like those kinds of things. So this is just it's just a point in time at how expensive it is, and to live in each particular place. And the point for this one is relative to everywhere else, really. It's how expensive are you in a particular place relative to the average and relative to other places. So what I'm going to show you in the next slide is like in no way perfect, because this index value, it's subject to whatever anybody includes in the index, and there's no units here. It's just, this is what the index value is. But I kind of was curious, if you sort of divided the index value, if you divided the average weekly wage by the cost of living index, can you get sort of a measure of like the relative affordability of a place to live just overall? And I don't really know if you can do this exactly, but the idea here is, so you can either live in a place that is particularly expensive or particularly cheap, or you can live in a place where your wages are especially high. And so in order for a place to be affordable. So what's interesting is if you look all the way over to the right, if you do this just kind of, frankly, a pretty stupid calculation, you see the District of Columbia is in a way the most affordable place to live because their wages are so high, like double what the average is. Even though their cost of living is quite high, their wages, according to this kind of silly calculation, more than compensate for that. So as you go to the right, you're more affordable by this kind of goofy definition. If you go to the left, places are relatively less affordable. So unsurprisingly, Hawaii, the least affordable place to live because it's expensive and the wages don't keep up with the expense of living there according to that cost of living index. Other places that are expensive, California, Massachusetts. But what's maybe surprising in a way is that New Mexico, because even though the cost of living is quite low, our wages are the lowest. And so that makes it relatively unaffordable to live here. Just again, just overall aggregate sort of numbers and kind of a silly calculation. But I just wanted to try to compare what affordability looked like in some way in the various places. What you see over to the right, Colorado and Texas, some of the more affordable, in quotes, places to live, affordable for different reasons. Colorado is affordable because their wages are high. Texas is affordable by this definition because the cost of living is low. And so New Mexico, fairly unaffordable based upon this particular definition of affordability. And you can argue with it. And I probably couldn't argue back too forcefully, but just kind of an interesting thing. Okay, so moving on back to kind of some forecast stuff here. Make sure I'm not filibustering too long. Okay, forecast for personal income growth by component, 2024 through 2030. And I don't have the slide going back through 2020 and 2021, but we had very fast rates of growth because of transfer payments. A modest growth 2023 and 2024, about 4.4% per year. We see 2024, 5.1%, 2025, also 5.1%. That's the expectation. 2026 kind of oddly jumps to 5.6%. Really, again, this is kind of coming out of what S&P is projecting for private wages and salaries. That's pushing things up. That's a little bit surprising to me. I think that might be a bit inflated, but nevertheless, that's what happens in the New Mexico forecast as a result. 5% in 2027, and then things kind of moderate throughout the rest of the remainder of the forecast. Okay, so we always project some alternatives. S&P has a baseline scenario. Everything I've talked about so far kind of is emanating from their baseline scenario and filtering through to our New Mexico model. They also have an optimistic scenario and they have a pessimistic scenario, and we filter those through our forecast to get a New Mexico optimistic and a New Mexico pessimistic. We also have a second pessimistic scenario that is kind of like a everything goes wrong pessimistic scenario. What's kind of the floor that we might expect barring another kind of pandemic-related incident. I'm looking at you, the bird flu. All right. So as always, there's still a pretty good degree of uncertainty. S&P global forecast, no recession is built into their baseline scenario, but employment growth is slow starting in 2026. FOR-UNM's forecast, so our forecast, slows in 2025 and slows even more in 2026. Already above pre-pandemic levels by 2023, so we're just kind of continuing to add jobs throughout. Again, the description of the scenarios. Pessimistic scenarios considers challenges facing New Mexico, access to federal loans, trend towards business consolidation, government budget cuts. And as I mentioned at the beginning, actually what's going into the S&P forecast, or if you go and actually read what they had to say in terms of their optimistic and their pessimistic scenarios, the things that they turn on the most, frankly, are the things I said at the very beginning: tariff policy and immigration. So in their optimistic scenario, the likelihood of things doing relatively well hinges on basically tariffs not being the tariff policy being a little bit more accommodating than in the baseline or in the pessimistic scenario. So less tariffs propping up the economy a little bit more, and immigration, and the administration being a little bit more sort of liberal with their immigration policy than maybe they have otherwise articulated. And so the optimistic scenario in those cases those are sort of the main factors that prop things up. The pessimistic scenario is exactly opposite of that: more tariffs or more stringent tariffs and a more restrictive immigration policy pushing things down. And so, of course, that filters through kind of implicitly to the New Mexico forecast. Okay. US real GDP forecast and alternative scenarios. On the left, these are real dollars. You can see the trajectory of the optimistic scenario is above the baseline scenario. The optimistic is in red, baseline scenario in black, a pessimistic scenario kind of in blue here. They all kind of generally increase. On the right, you can see what the changes in the growth rates are. You really see a bump at the beginning in the optimistic scenario, as a result of more accommodating tariff policy and a less restrictive immigration policy. You see the baseline scenario really kind of trail off, and obviously GDP growth very slow throughout that period of time, averaging in each of these years below 2%, at or below 2%. And so I'll remind you at the beginning what I said, kind of an interesting thing that happened over the last 4 years, again, coming out of the pandemic and during the recovery period. Nevertheless, 4 consecutive years of growth being at or above, annual growth being at or above 2.5%. But this forecast, and again, coming from S&P, is projecting 2% or lower in their baseline scenario throughout. And even in their optimistic scenario, only 2026 gets above that 2.5% number. Pessimistic scenario really kind of takes a bit of a hit in 2025, goes slightly below 1.0% in 2026, and only slightly above 1.0% 2027, and then starts to kind of catch up in terms of rates of growth thereafter. In terms of employment, this is actually one of the areas where things are a little bit different in this forecast, and that is because employment levels in black here, and this is US, are pushed down in the baseline, which actually makes the optimistic scenario kind of show up here in the last, I don't know how many years. The optimistic and the baseline scenario were almost kind of covering each other. In the pessimistic scenario, a little bit actually. So the interesting thing here is relative to the optimistic scenario, the baseline scenario is kind of pushed down a little bit, revealing the optimistic scenario a little bit more. And the pessimistic scenario, even though the pessimistic scenario is coming from those things that I articulated already, is actually not quite as pessimistic as in the past. So we have a better identification about what those things might cause the pessimistic scenario to occur might be, but the effect of the pessimistic scenario relative to the baseline scenario isn't quite as bad as in the past. Okay, so this is comparing the national forecasts amongst the last, on 6 forecasts that S&P has put out. So January 2025 is the black line. GDP is on the left, and these are GDP levels. So GDP levels in this forecast are just ever so slightly below what they were in October. So you can barely tell, but October's slightly above. Employment is where you actually see it a little bit more. So 2025, compared to October, the January 2025 forecast, the October 2024 forecast, similar in 2025, but then you start to see employment losses actually eat into things, such that compared to our last couple of forecasts, employment levels are actually below what we were expecting the last basically 6 months. In New Mexico, how does this filter through to our forecasts? So the red, again, optimistic. We can see the optimistic scenario this time. It's a similar story to the US. It actually is revealed because the baseline is pulled down a little bit. So we can actually see what's going on in the optimistic. It's a little bit more optimistic. And the pessimistic scenario is a little bit less pessimistic than it's been in the past. The pessimistic 2 scenario, we're kind of really losing jobs 2026, 2027, 2028, basically flat. It takes us until 2029 or early 2030 to get back to 2025 levels, which is, for all of the scenarios, basically what the post-pandemic peak is 2025. So hopefully we don't end up in that scenario. But the other scenarios up here that are just strictly running through the S&P forecasts generally mirror those forecasts pretty well. Okay, so very quickly, I'm going to talk about the metro and non-metro areas. So the Albuquerque, what you're going to see in a lot of these forecasts, again, we only have QCW data through the second quarter of 2024. And so that's what you're going to see on these slides. What you're going to see in most cases is that the most recent quarter of data is the smallest job addition. So this is year over year job addition, number of jobs in thousands. So if you look at Albuquerque 2024 quarter 2, 4.752, that's 4,754 jobs. So anyway, that's generally speaking kind of the lowest number added over the period. So the post-pandemic period, we're really slowing things down in many of the places of the state. So Albuquerque, Las Cruces, Santa Fe, generally, we've been quite low in terms of job addition over the last year, year and a half. Lea County, one of the slowest rates or smallest number of jobs added in the most recent quarter, year over year. Farmington, slowing down, only about 475-ish jobs added. Rest of New Mexico, by far the slowest number of jobs added, sort of over this recovery period shown. Okay, so I wanted to know for each of the places, is there really much of a difference in terms of where jobs are being added or expected to be added? If we take kind of 2020, our expectation for 2024 as a given, and kind of using that as the base year and looking at the number of jobs added in each of the industries in each of the places. And so what you're going to see in most of these slides is that healthcare is where a lot of the jobs are going to be added. Also construction, and to a lesser degree, in some places, professional and technical services. So this is where we're going to see a lot of the jobs added. Jobs contracting, most places you're going to see it in retail trade. So Albuquerque, again, healthcare, construction, and professional and technical, retail trade pulling things down. Las Cruces, very similar story here. We're seeing construction to some degree, healthcare and social assistance also pulling things up, retail trade pulling things down. And again, this is just the total number of jobs starting from 2024 or 2024 kind of projections through 2030. Santa Fe, healthcare and social assistance, construction, arts and recreation, they've kind of got a disproportionately large industry there. A little bit larger state government, probably unexpected, or excuse me, probably expected there. And retail trade kind of pulling things down. Lea County, this is the one that's really kind of different. Mining, adding the greatest number of jobs, but construction, because construction filters into mining, obviously filters into other things as well. But it is an industry that correlates well with mining, adding a large number of jobs. Admin and waste management, similar story there. Healthcare and social assistance, one of the slower, smallest increases happening there. And so, Here we are, retail trade also pulling things down. Farmington, so this is more like the other MSAs. Largest number of jobs, healthcare and social assistance. Also here, again, probably here relative to the population size, more than just about anywhere else, super underserved in terms of healthcare. And so there is this kind of huge kind of gaping hole in this industry in terms of the supply of labor. And so you would expect, hopefully, that especially with state policy and such, that hole would partly be filled over that period. The loss is really coming from retail trade. Okay, so that's all that I have. Our next forecast is Friday, May the 2nd. And so just kind of putting that out there. So pencil that into your calendars. Be happy to take any questions that anybody has online, if anybody has anything, or anybody in the audience. Unless I explained it perfectly. I put your minds at ease for the coming however many years. Okay, well, if anybody online has questions at any point, feel free to reach out to me or to Rayanne, and she'll forward me your queries. And why don't we go ahead and take a break until 11, actually, and then we will have our guests from PNM come up here and tell us about the good work that they're doing.
Some way to share it. Yeah, if you want to email it, I don't care. I just sent you an email from Clinton Turner.
Oh boy.
He was sending me stuff in the chat. And he was just sent you stuff to look at. He would like your opinion.
Yeah. Oh, sorry.
Should we turn both mics on?
My voice is gone. Do you want me to send it to you on Teams or do you want me to email it to you?
I don't care.
I will show you. Yeah. Um, the difficulty. Do you want me to dictate to you?
That or you can come and just type it. It's up to you.
Yeah, yeah.
Like on my screen, the window I see is.
Oh,
So it's like our
okay, she was fine.
Yes.
Right, so I saw what you got.
I basically just copied.
Oh man, I was on. Wasn't my choice.
Milo?
No, like.
Oh.
Yes.
Six. Cheers. So I only have two mics.
Sure.
So.
Yeah, you can put them on, you can hold them, you can do whatever you
Yeah.
want. Up to
But
you.
they're both on. So, yeah, I don't know how you want to do this. All three of you are talking.
It's gonna work out just fine. And then there's this thing, if you want to use it to advance the slides, it's down. It's down to advance.
Great.
And if you're feeling real saucy, you can laser point, but that's up to you.
And do I need to do anything fancy other than pick this up? Don't need to hit an on switch, said they're on. Nice.
Oh, yeah. You guys ready to go? Okay, cool. Well, hello, everybody. I'm back. This is my, okay, cool. So we're going to go ahead and get started. We've got our guest speakers with us here today, folks from PNM. Without further ado, I'm going to go ahead and just pass it off to them. So welcome. Thank you so much for being here. And there you go. feel free to use the clicker or whatever.
Oh, perfect. Thank you. Is up next slide?
Down is next.
Down is next. Thank you. I always get that backwards. Hi, good morning, everybody. I'm Elisha Saavedra. Can you hear me? My voice does not carry well. So I just want to make sure, can you hear me in the back? Because I have a small voice, as you might imagine, goes with me. So little known fact, I only hire really tall people to make up for, no, I'm kidding. But for those of you who don't know me, I'm Elisha Saavedra. I've been with PNM about 15 years. And currently I serve as the Director of Customer Marketing. So I have economic development, large account management, and B2B marketing under my purview. And so I'm always excited to get opportunities to come out and speak to my fellow data folks. My background is that I'm an economist by education. So this is, you all are my people, and I'm happy to be here. But my second passion is really customer service. And so really excited to talk to you guys today about how PNM serves our customers in our community. You might have heard that PNM recently had a name change. Our parent company had a name change. And so we used to be PNM Resources. We are now Texas New Mexico Energy. There's been a lot of speculation about why that is. I was actually personally a part of that name change decision, and I can tell you all the rumors are not true. It is not because we have a bigger focus on Texas and less of a focus on New Mexico. Really what this was about was being able to attract more capital so that we can continue to build and meet the demand that we're seeing in economic development, both in New Mexico and in Texas. Just a quick overview of Texas New Mexico Energy, formerly PNM Resources. We do serve, as I said, New Mexico under PNM. That name will not change. The focus is still on customers. That will not change. And then we also have TNMP in Texas. So I represent PNM only. We serve here in New Mexico just over 500,000 customers. And we have about 15,000, a little bit over 15,000 miles of transmission and distribution lines here in New Mexico. To give you some perspective, I often say that PNM is the smallest, largest utility of any state. So we wanted to kind of give you some perspective on how that works and why that is. So on the far left side, you'll see the map of our investor-owned electric utilities. PNM is an investor-owned electric utility. And so you'll see the various service territories of those folks. In the middle, you can see PNM's service territory, which is really kind of all over the place. We've got little bubbles here and there. We serve the most populous areas in the state, with the exception of Las Cruces. And that's why we're considered a big utility in New Mexico. We serve the most in terms of the number of customers. But if you look at geographically, the co-ops really serve the most area within the state. And so you'll see there's lots of cooperatives all over the state. And those are, interestingly enough, serving less customers because they're in the more rural areas. Some key things that we want to note are we are really centered around being green, being carbon emission free, moving New Mexico toward a clean energy future. And that is something that has not changed even with the change in the federal administration. This is something we're going to continue to be focused on. We continue to make investments in green power replacement. We're also doing a lot of research with some of the national labs and things like that to continue to find new sources of clean energy. So some examples of those, renewable and storage, like solar and wind, geothermal is another one. We're also looking at next generation battery technology, pumped hydro, green and blue hydrogen, as well as other emerging technologies. We know that there's a transition needed right now because many of those technologies are not advanced enough to move forward with serving customers. So there will be a gas transition that has to happen, but we're very much looking forward to meeting the ETA goal of 2045 to be carbon emission free. Within PNM, we are really focused on three things. We're focused on education, environment, and economic development. And so that's why I'm here today. We are really dedicated within the economic development department to serving really any kind of customer that might want to grow in New Mexico. So they're already existing, they want to grow, or new customers, new industries that are looking to locate within the state. And our role, as we see it, is really to be the quarterback. We bring in the customer, we understand what their needs are. I call it triaging because I've got a lot of medical folks in my family. So we triage the customers, we understand what their needs are, what their challenges are, what their goals are, short and long term, and then we bring the right folks from within PNM to the table to have those conversations. My team is small in economic development, but very mighty. So I serve as the director over customer marketing, under which economic development falls. And then we also have a segment analyst, Erica Baca, who unfortunately couldn't be with us here today, but she is online. And then I have Antonio Granillo. He is brand new to the team, and we were just joking, just his second week, and we've already put him to work. So he's here today to tell you all about what he's learning. And then Grant Taylor, who many of you probably know from lots of his work around the state over many years, all very dedicated to economic development. He's really the brains of the economic development operation here at PNM. And so with that, I'll turn it over to Grant.
Thanks very much, Elisha. So if I may, I'd like to sort of level set by applying a series of lenses through which we view economic development. The first, we subscribe to the definition by the International Economic Development Council that economic development is that work that improves quality of life as well as the well-being for communities by creating and retaining jobs, as well as contributing to a stable tax base for those communities. We also subscribe to a narrower definition of economic development that is used in state statute, as well as economic development department policy. And that is that we're really focused on recruiting and retaining those jobs that are created by economic-based businesses. And what does that mean? That means that at least 50% of that company's revenue is derived from the export of goods and services, thereby bringing in or importing new money into the state as well as into those communities to pay local workers and to hire local vendors. So these employers that export goods and services are essential to local commerce as well as to economic growth. And then at PNM, economic development projects really come into focus based on their electric size. So for the potential new economic-based customers, we are looking for those to have at least 1,000 kilowatts or 1 megawatt of demand or load. We also work with those existing companies that have 500 kilowatts of load, or they're large load customers that are looking to grow by at least 200 kilowatts. And so for reference, what might be a business that's 1,000 kilowatts, imagine a medium-sized machine shop or even a beverage bottling manufacturer as being between 1 megawatt and 2 megawatts. PNM's economic development team sources its projects from a variety of partners, from the state level to local partners. The Economic Development Department, as well as the partnership, sourced many of these projects. I'll explain a little bit more in a moment. We're also working with economic development departments within local government agencies and local and regional economic development organizations. We also work with landowners, brokers, and developers. Site selectors, those are consultants whose job it is to optimize a location decision on behalf of a company. More and more, and we'll talk more about this in a moment, we are getting directly contacted by companies. And that's in part because electricity is such a critical path to the success of a project. And then we're also working on projects with our existing customers. So electricity is important to any business, and we would like to think of ourselves as very important in that regard, and we take our job seriously. But in the way of economic development projects, we know that we are just one piece of the puzzle. What's been really nice being at P&M is Elisha has modeled for us that even though we're just a small part, we should be playing such a role that we are in the running for best supporting actor on every one of these projects, that we are a major contributor to the success of any of these projects. So the New Mexico partnership will receive a request for information that gets turned around as a potential recruitment opportunity, or PRO. That is typically received from a site selector, sometimes from a company, and then those are distributed to regional EDOs and local governments to be able to provide responses. So for example, there is a manufacturer located on the East Coast. And in order to reduce costs, that manufacturer decides they need to have manufacturing operations closer to their customers in the Western United States. They commission a consultant, a site selector, to conduct a site selection process. That site selector will put together the RFI, distribute that to either select or all Western states. So then received by the partnership and then disseminated to local communities for responses. Once it's received at P&M, we are working with a combination of a few or all of the nodes that you see here in this hub and spoke model. So we may get some initial questions on a first pass of, tell us the capacity that you have, tell us if you can serve a project within a certain time frame. But as there are subsequent rounds in the site selection process, those questions may get deeper. And so we may be recruiting more or a larger team to be able to make those responses. And as we get closer to, say, an announcement, if we are successful in recruiting a project, we're going to bring on more and more of a team until we can bring a project under contract. So some of the other questions that they will ask of us is, can you provide us with cost estimates? Can you tell us what's going to be the rate by which we'll be paying on our monthly bill? And then for our larger customers, we are providing to them very detailed proposals that are rolled into the responses that are delivered to the partnership and then delivered to that site consultant. So this is a very text-heavy slide. Forgive me for that. Really, the major points that I want you to take away from here is that this is a very competitive environment, and we have to move very quickly in providing these responses. Typically, when the partnership disseminates a PRO, we only have days, collective days. We've done some research, and we have found that on average over the last few years, we're only given 11 days to be able to respond. And I say we, talking about partnership, only has 11 days to disseminate the PRO, collect responses, package that proposal to the site consultant, and try to get to the next step of that site selection process. So in those 11 days, that includes that dissemination, the collection, and so forth. So it's really tough. We take our role very seriously in trying to provide complete responses. This is a process of elimination. If we don't provide those complete responses, if we fail to provide those answers within the deadline, it's very easy for that site consultant to eliminate the state or eliminate a community from the running for these really meaningful projects. In addition to the time it takes to respond, we have to also make sure that our ability to serve a project is within their desired time frame. Very often we have projects that say we want to be operational in 18 to 24 months. Depending on their location, depending on their size, depending on many, many factors, our time frame to serve that project might not line up with their desired start of operation. And that can mean that we're a critical piece or a deciding factor in losing a project. On a monthly basis, we are compiling what are the projects that we have in our pipeline. We've produced what we have traditionally called our dashboard to leadership. This is what you see in the next few slides that Antonio is going to talk about. Our thanks to our colleague, Erica Vaca. Our shout out to her online. So Antonio, do you mind talking about our pipeline?
Thanks. So yeah, as Grant mentioned, we produce a monthly economic development dashboard, primarily for internal stakeholders at PNM. So like that image that Grant shared showing all of the different departments within PNM that are involved for economic development projects, each of them require this pipeline information in different formats. So like Grant mentioned here, you can see that for each month since August, the total load size has hovered around 4,000 megawatts. And to give you a scale, PNM's current capacity is around 2 gigawatts, or around 2,000 megawatts. And we've taken just over a century to build that entire capacity. So just showing you the immense demand that we have here. One other interesting fact about each of these is, as you can see, the majority of the load is projects that have 300 megawatts or greater, and all of those projects right now in our pipeline are data centers, which we can see by here. We show that same load through different industries that we capture, and this helps each of the different teams inside of PNM better understand what these operations are actually going to look like. So you'll see that we have categories that don't correspond directly with NAICS codes, but give us a better snapshot of what these projects are actually going to look like on the ground. Again, data centers, nearly 87% of the total load that is demanded in our pipeline is coming from data centers. And you can also see in the table at the bottom, we have the projects broken out by different stages based on where we think they are in terms of actually locating here in New Mexico, or if it's an existing company that is expanding, how likely is this actually going to, what is the likelihood of this actually coming to fruition? And so again, you can see that data centers are making up the large share across all of the stages, and a majority of the projects, which right now is around 35 projects in the pipeline, are in that early stage. And as Grant mentioned, we categorize those projects as leads when we get that first request for information, where they might be doing a whole national search. So New Mexico might not be, near the top of their list, but we're still providing all of that information that they've asked for. I guess the other thing that I would say is, with each of those, although data centers, make up a large share, and compared maybe to manufacturing, the total economic impact of data centers is not significantly large. These are still creating jobs, especially we've seen, significant impact in some of our smaller communities. And Alicia can definitely speak more to the impact of Meta and their data center operation that is located in Los Lunas in terms of the overall growth that we see in wages, housing, school quality, things like that. So why are data centers taking over, it seems, our whole pipeline? We can see definitely that the proliferation of AI across industries is really increasing that demand overall. And what's also important to remember is that, this type of automation is happening across industries. Like was mentioned earlier with, manufacturing, fewer jobs, more processes are being automated in the operation. That requires more power and more electricity. So, this isn't exclusive to the data center operation, but the overall power demanded by all of these projects is increasing from historical averages. And then we also create a 10-year forecast that is used internally to determine how much power is essentially what does PNM's investment look like over the next 10 years to meet this power demand. And the forecasting team incorporates economic development projects to ensure that they're capturing these larger loads. And so you can see that slightly counterintuitive, but our low forecast includes those economic development projects with a high probability of locating here, which is why it's going to be the most conservative forecast. And then those are projects that have announced that they are coming here and that they're creating a certain number of jobs, as well as most times having a contract in place already with PNM. So we're sure that they're actually going to locate here and the infrastructure will be in place in time to meet their demand. Mid will include a lot of those later projects that are further along. PNM has invested a lot of time from their engineers to be able to answer all of the questions. And there's been a lot of communication back and forth. And then the high forecast includes a majority of the projects, but those projects that are beyond that first request for information stage where, maybe New Mexico has been included after the first round of site selectors eliminating a certain number of states. What you'll see is that in those first couple years, there's that huge jump in terms of the potential load. And that goes back to what Grant was saying about most of these operations wanting to be in operation within 18 to 24 months, meaning that they expect access to that size, by 27. And one of the challenges with this is, how competitive are we? We're not competing, within New Mexico, we're competing with other states and other regions. And so that's why we're making the case that this really needs to be a statewide effort to meet this demand and for PNM to meet the infrastructure needs for each of these companies. And yeah. Oh, and then the other thing that I wanted to mention was within this does not necessarily include the forecast of like existing customers that might be growing. This is solely looking at economic development projects and those that will be growing here. And with that, I will pass it back to Rex.
So we mentioned that we play a small part, but we are certainly enormously proud whenever a community or the state captures a win with an announcement of a project. So here's a sampling of what projects were announced in 2024. The very first one might seem like a bit of a mystery. Alpidin Investment Company has secured a site at West Point 40, that's at 98th and I-40, to build a small data center, relatively small. Some of these you might already recognize from the news. Rocket Lab having a subsidiary here in Albuquerque, a longtime one being Solero. And we mentioned Maxion in this list. You may recall that that original announcement was in August of 2023, but Maxion has reimagined its phase one of establishing operations in Albuquerque. And it was in December that it made news, having signed a lease for operations, a 5-year lease at the Honeywell site that's near Balloon Fiesta Park. But you can certainly see some of these metrics by way of job creation and their economic impact that there's no small part that the utility and others play in making these projects come together. So with the constituency of BBER, many of you being opinion leaders about policy and about economic development in New Mexico, we would be remiss if we didn't pass your way some of the policy reforms that we find to be important. First of all, you may have heard the phrase site readiness being really important for this current legislative session. That idea is that there's more that can be done to make sites competitive for the site selection. Since it's so important, since speed to market is so important for many of these companies, they can't wait for there to be grading and for there to be utilities brought to a property line for them to begin their own construction. So we're trying to address a number of things. And so the challenge for us as the electric utility is that we have so many of these companies saying they need power within, say, 2 to 3 years, for many of those being 18 months to 24 months. Over the last few years, we have seen the average ask in capacity go from about 43 megawatts to now 114 megawatts. You can see that that's really substantial. There's a variety of reasons why we can't meet those timelines. It can be supply chain. For example, an auto transformer might take 4 or 5 years for us to be able to take delivery. And so we can't even begin construction or installing that important piece of equipment until we take delivery of that equipment. We're now trying to move to every couple of years having a rate case before the PRC. Cost recovery is really important to us, but even though we're trying to have a more frequent rate case before the PRC, it could still take 6 or more years for us to recover costs that we invest for these projects. So we're trying to reduce risk. We want to make sure that New Mexico is competitive for these projects. And we think that the answer is doing this in collaboration with stakeholders like the PRC and with the legislature. So this issue is not unique to us. Water utilities face this, gas utilities face this. And we think collectively that it's important for us to have faster timelines to be able to build, that we're able to build ahead of these customers. We've proposed, in our case, and in agreement with other utilities, that having the ability to pre-build up to 10% capacity each year, especially in the way of generation resources, would allow us to be competitive. Also, that we should be able to pre-stock or pre-order and inventory those long lead items that really make it difficult to meet timelines. And then also for what investments are made, that we have the ability to recover costs in a more timely fashion so that we reduce risk. So that's a policy reform that we're looking at that could be of benefit to the service territories of a variety of utilities. We think that a really nice complement to this is one that can be done at the local level for site readiness. So the way that I pronounce this is LEDA LOGART. That stands for Local Economic Development Act, Local Option Gross Receipts Tax. This has been on the books since the 90s. It's a little bit obscure, but in 2019, Representative Jason Harper was able to get the increment that is able to be dedicated to economic development plans and projects doubled. So for municipalities, it went from an eighth to a quarter, and for the counties, a 16th to 1/8. And what's important to note is that this section of LEDA requires that in order to pass this increment for that particular use, it has to be a ballot measure by referendum before the voters. I have to see these kinds of numbers in like whole numbers, not just like eighths and sixteenths. So what this would mean is that this increment could generate 25 cents per $100 of purchases at the municipal level, 12.5 cents per $100 of purchases at the county level. Last year, I did a study of 28 jurisdictions within PNM's service territory. And if the eligible municipalities and counties were to pass what they have available to them in that increment, because some have actually passed portions of that increment already for other uses. But if all of those jurisdictions were to pass this increment, it would add capacity to economic development efforts by $120 million annually. This is actually what has been the secret sauce of Texas since the 90s. It is not the enterprise closing fund in Texas that is winning them many jobs and many large projects. It's actually what capacity has been available at the local level. There are communities who have this economic development sales tax passed, and they essentially have war chests that outpace and eclipse what we have available at the state level in New Mexico. So this is one idea that I hope many of you will kind of think about, maybe share with local leaders, that this is really important for us to be more competitive in the economic development environment. And with that, we'd like to open the floor for questions.
So all of the factors that you talked about in terms of site readiness, would you say that, do you think electricity is the bottleneck, or do you think it's water, or just the space that's developed, or is there anything like consistent kind of across the board? And also, I have a second question, completely different than that, but that is, compared to, you mentioned Texas in comparison to like here, what have you. But for other utilities that are similarly sized to PNM, or that have a service area that's similar, what have you, like what do they do relative to what you guys do in terms of economic development? And do they have some of the same challenges, or?
Sure. So I'll start with the site readiness question. So I don't think that we are where the bottleneck is happening on these projects. I think it really is a collective. We're looking at several utilities at one project. It is gas, it is water. Oftentimes we're having to talk about extending miles of water lines to be able to serve projects, especially those that have any relation to semiconductors, which is pretty water heavy. I think many developers would talk about the time it takes for permitting, that much of what they need to do in the way of grading the land cannot begin until they have the permitting. If that takes such a long time, they can't even begin that. So I think it is an all hands approach that's happening right now. That's why we've got this umbrella site readiness legislation before the legislature that's being championed by Secretary Designate Rob Black with the Economic Development Department. And we're going to just take bites in the way of policy that we can to try to truncate the time it takes to bring these projects to fruition. So then what about other utilities?
So the only caveat to that I would say is that because these projects are becoming more and more power heavy, we're becoming a more important piece. So while I completely agree with Grant that there are lots of bottlenecks, we're in the desert and water is always a challenge. We're rural New Mexico for the most part, and so infrastructure is not as easy to have in place as say New York or New Jersey, those types of areas. But yes, we are becoming a more and more highlighted bottleneck of all of those because they are heavy power users.
What about in other states?
Oh, okay. So one of the things that I will say is that, and I'm really proud of this, New Mexico is punching above our weight right now. We're winning projects against states that have historically just completely obliterated everybody else. And so a lot of that I have to give kudos to the level of collaboration that has I would say started maybe about 5 years ago among local economic development leadership, and that's across utilities, that's local EDOs, that's at the state level. We just really got together one day and said we need to work together on this if we're going to win. And that made a huge difference. And so you're seeing pages of announcements instead of like Intel, and then 20 years later it's Meta, and then, or 30 years later was Meta, and then maybe 10 years. So what you're seeing is you're seeing a lot more announcements, and that's really what's driving it. We're hearing from site selectors and from companies that New Mexico has it together, that we are collaborating better, and that's been a competitive advantage. The other thing that we hear that is a competitive advantage for us is how easy it is to access local leadership. So again, small state, but that actually is being used to our advantage right now. You want to meet with the governor? No problem. We'll get you in to meet with her in a couple weeks. You want to meet with the mayor? No problem. He'll take you to dinner. And those are things you can't get in bigger states. And so that helps us as well. Some of the challenges that we deal with are the fact that we're not super urban, that we have a lot of dispersed communities. We have not made investments. We've not made significant investments in our utility infrastructure for a long time. The last major development PNM had was in the 70s. And so that coupled with our very aggressive, and it is aggressive, goal to get to carbon emission free is also something that's been a real challenge for us. And so you heard me talk a little bit about the gas bridge that we're having to put in place while we look for how to get to that carbon emission free by 2045. That's probably going to be new technology that gets us there. And so there are some challenges there, not unique to utilities. So you're seeing this across the nation, across the world. There's a capacity shortage, and that's because renewables give you energy, but they're not consistent, right? So you have that when the sun is shining, you have wind when the wind is blowing. But what we lost in shutting down baseload generation is the consistency, the capacity. And so I would say most other utilities are having that same challenge. For us, it's exacerbated because we're further down the road with moving toward renewables. And so our capacity challenge is unfortunately about 10 years ahead of some of the others. Thank you for your question.
Well, thank you guys. Yeah, thank you so much.
Yeah, thank you all so much for being here. We really appreciate it. Yeah, that was excellent. Super helpful. Yeah, so again, thank you all for being here. We really appreciate it. For those of you who are here, obviously we have lunch and goodies, cookies and things. So but we look forward to seeing you, what day was it, May 2nd? May the 2nd for our spring forecast meeting. Thanks again and have a good weekend.